Here's a question that stops a lot of people in their tracks. You hear that the stock market has been on a run. Headlines are calling it a record year. Your coworker mentions their portfolio, and you think, I should probably be doing something with my money. But then you open a brokerage app for the first time and you're staring at thousands of ticker symbols, earnings reports, price-to-earnings ratios, and analyst ratings. And suddenly, that idea of investing feels a lot less like an opportunity and a lot more like a pop quiz you never studied for. So you close the app. You tell yourself you'll come back when you know more, and that's a problem. Because according to the Philadelphia Federal Reserve, nearly 40% of Americans who don't invest in the market say the reason is a lack of understanding, not a lack of money. Here's what nobody tells you. You don't have to pick individual stocks to be an investor. There's a whole category of financial tools built specifically for people who want to participate in the market without becoming a full-time analyst. They're called investment funds. And by the end of this video, you'll understand exactly how they work, what the different types actually mean, and how to think about choosing one.
What is a fund, really? Let's start with the core idea. An investment fund is, at its most basic level, a pool of money. Imagine a group of neighbors who each want a vegetable garden, but none of them has enough room or enough money to grow much on their own. So they decide to combine their resources. One neighbor chips in, then another, then another. Now they have enough to plant tomatoes, peppers, carrots, squash, and beans. Here's what's interesting about that arrangement. If the tomato crop gets wiped out by a drought, they still have 4 other vegetables. No one neighbor loses everything because no one's money was tied to just one crop. That right there is the logic of diversification. And it's the foundation of every investment fund. Now, bring that idea into finance. A fund pools money from hundreds, sometimes thousands of investors. That combined capital is then used to buy a range of assets, typically stocks, bonds, or a mix of both. Each investor owns a proportional slice of the whole portfolio. Say you invest $100 into a fund that holds equal stakes in 10 different companies. You now have $10 worth of exposure to each of those companies. If one of them has a rough quarter, your $100 doesn't disappear. It bends. It doesn't break. That's the fundamental promise of a fund. Shared risk through shared ownership. Most funds also come with professional oversight. There's a manager, or in some cases, an algorithm, watching over the portfolio so you don't have to track earnings calls or read balance sheets every weekend. Now, not all funds are built the same, and the differences between them matter a great deal.
The 4 types of funds. Let's start with mutual funds. A mutual fund is the original version of this idea. You hand your money to a professional money manager. They decide what to buy, what to sell, and when to do it. Their goal is usually to beat the overall market, what's called an actively managed approach. Sounds reasonable, right? Pay an expert, get better results. Here's where it gets complicated. That expertise costs money. Mutual funds charge what's called an expense ratio, an annual fee expressed as a percentage of your investment. The average expense ratio for an actively managed equity mutual fund is around 0.60% per year, according to Morningstar's 2024 data. That might sound small, but on a $50,000 investment, that's $300 a year, every year, whether the fund goes up or down. There's also a structural quirk worth knowing. You can't buy or sell a mutual fund during market hours the way you'd buy a stock. Trades are processed once per day after the market closes at a price called the net asset value, the NAV. Many mutual funds also require a minimum investment that can run into the thousands of dollars. Now let's talk about index funds. An index fund is a different approach entirely. Instead of paying a manager to try to beat the market, an index fund simply tries to match it. It tracks a preset list of companies, an index, like the S&P 500, which covers roughly 500 of the largest publicly traded U.S. companies. Think of it this way. Picture a fund that tracks the 50 largest U.S. technology companies. Every company on that list is in the fund. If one company falls out of the top 50 and gets replaced by another, the fund automatically sells one and buys the other. There's no manager making a judgment call. The rules do the work. Because there's no active stock picking, index funds cost dramatically less to run. The asset-weighted average expense ratio for passive index funds sits at just 0.11% per year, compared to that 0.60% for active funds. That is, roughly speaking, 5 times cheaper. That cost gap turns out to matter more than most people realize. We'll come back to that. ETFs, exchange-traded funds. An ETF functions a lot like an index fund in terms of what it holds. The key difference is how you buy and sell it. ETFs trade on a stock exchange throughout the day, just like individual shares of Apple or Tesla. You can buy one at 10 a.m. and sell it at 2 p.m. if you want, or hold it for 30 years. Entirely your call. This makes ETFs the most flexible and accessible option for most Americans. Many ETFs can be purchased for the price of a single share, sometimes as little as $20 or $30 through any major brokerage app. No minimum investment thresholds, no waiting until the end of the trading day. Most ETFs are passive and track a specific index, but the category has expanded considerably. Today, you can find ETFs tracking everything from broad U.S. markets to specific sectors like renewable energy, cybersecurity, artificial intelligence, and more. In 2024, total assets in U.S. passive mutual funds and ETFs surpassed actively managed funds for the very first time, a milestone that signals just how dramatically investor behavior has shifted. Hedge funds. Hedge funds operate in a different world entirely. They're reserved for ultra-wealthy individuals and large institutional investors. Minimum investments can run into the hundreds of thousands or millions of dollars. Hedge funds use aggressive, high-risk strategies, short selling, leverage, derivatives, complex bets on market movements. The goal isn't just to beat the market, it's to generate returns regardless of which direction the market is moving. That kind of strategy can produce spectacular results. It can also produce spectacular losses. For the vast majority of everyday investors, hedge funds are simply not part of the conversation. But it's worth understanding they exist because they're often the version of investing that gets the most dramatic coverage in the news. Which fund is right for you? This is where a lot of people expect a simple answer. There isn't one. But there are some useful frameworks. If you're starting out with a small amount of money, ETFs are almost always your most logical entry point. Low fees, no minimums, instant liquidity, and access to broad diversification. Most major platforms, Fidelity, Schwab, Vanguard, offer commission-free ETF trading. If you prefer a hands-off approach and don't want to watch prices fluctuate throughout the trading day, a mutual fund or index fund through a retirement account like a 401k or IRA might suit you better. You invest on a regular schedule, the money goes to work, and you don't have to think about it. If you're considering active management and paying for a human stock picker, here's a data point worth sitting with. According to S&P Global's SPI-VA research, over a 10-year period, roughly 90% of active fund managers failed to outperform their benchmark index. Morningstar's 2025 analysis found that just 21% of actively managed funds survived and beat their average passive counterpart over the decade through mid-2025. Even during periods of high volatility, elections, tariffs, geopolitical shocks, the kind of environment where active managers claim to shine, only 33% came out ahead. And that's before accounting for the higher fees that slowly erode your returns year after year. This doesn't mean active management is never worth it. In niche categories, in specific bond markets, for investors with specific goals, it can make sense. But for most people building long-term wealth, the data consistently points in the same direction. One thing that often gets glossed over: all funds carry risk. A low-cost index fund that tracks the S&P 500 will drop significantly in a recession, because the entire market drops. Diversification protects you from individual company failures, not from broad market downturns. If you invested in January 2008, your portfolio looked very different by January 2009. The question isn't whether your fund can lose value. It can. The question is whether you have the time horizon to let it recover, and whether you've chosen a fund whose cost structure isn't quietly working against you while you wait. Here's the big picture. Investment funds were created to solve a real problem. Most people don't have the time, the expertise, or the appetite to analyze individual companies. Funds let you access the market's growth without needing to become a professional trader. The type of fund that makes sense for you depends on your goals, your timeline, and how much you want to pay in fees. But the core insight is this: The most significant barrier to investing for most Americans isn't access to good investments. It's the false belief that you need to be an expert before you can start. You don't. If you found this useful, consider subscribing. We break down financial systems like this every week. And if there's a specific fund, investment vehicle, or money concept you want us to cover next, drop it in the comments. We read them all.